Cool. Thanks, Jeanette. I appreciate it. Well, welcome everyone. Happy Saturday. Hope you guys are all doing well. I know sitting through a series of presentations like this usually takes a little bit of stretching legs, so I hope you've gotten the chance to maybe take a quick sip of coffee or something or whatever you need to stay alert. But what I want to go through with you guys today is something I think is extremely timely from a market perspective, kind of where we are. So the question I have for you, and I'm assuming you can see my screen, by the way, it should say is stock market volatility about to spike? And just to be very clear, I am extremely market agnostic. I believe, I've done this for nearly 20 years, and I believe being opinionated in the market is one of the worst things that you can do. So this is not for me to have a strong opinion, but rather to give you some food for thought and something that I think from a tool and education perspective is extremely important to keep in mind. So is the stock market really about to spike? Let me give you guys a couple of charts and a couple of things to think about. So here's the VIX. This is also known as the CBOE Volatility Index. Basically what it is the implied volatility of the S&P 500 options. And what you can see if we look at this chart, it's about 15 years of data. You can see basically right now we're at 10. And historically speaking, that's quite low. In fact, a few weeks ago we reached well into the 9s. And I remember last time when that happened, that was actually in 2007. I was at the trading desk at JP Morgan, and I remember exactly what happened soon after that, and basically volatility spiked. Just for a little bit of historical context, when the VIX stays below 11 or even stays below 10 for a number of weeks or so, we tend to get quite close to a volatility spike, historically speaking. Okay, so that's number one. In terms of duration, well, we're now 8 years into a cyclical bull market in terms of the S&P 500. So that's your basic sort of benchmark S&P 500 US index. And the thing is about market tops, at least in the immediate term ones, volatility rises slowly, and then it kind of comes to hit you over the head all at once. And what I'm trying to do here over the next hour is to get you prepared for that, both from an educational perspective and also, of course, we're talking about tools today, so there's something that I use that I think is going to be literally imperative to use. Shifts in market environments is basically where most investors and traders give back a lot of their gains. So think about that. So a lot of people right now are invested in the market as they should be. We've had a raging bull market over the past 7, 8 years or so, and a lot of people have become very agnostic in the market. Now, obviously, the market continues to rally higher, so we don't want to disrespect that. But what we have seen time and time again, what I've seen on trading desks I've worked at around the world, both in Europe and the U.S., and certainly also managing money now for the past 7 years directly, has been when people get complacent, that's usually when they start making big mistakes. And we haven't seen a real shift in market environment in now about 8 years almost. And I do think that's going to cause a lot of pain because people won't take it serious when it actually happens. So get prepared now with the right approach and tools. That's my sort of warning sign. Again, I don't really believe in hype and things of that nature, but this is what we talk about. I have a extensive network of hedge funds and institutional investors I speak with on a daily basis, and that's kind of what's been our theme for the past, literally just the past few weeks or so. We want to start getting prepared for that kind of thing, not by dumping all our stocks, but just kind of, getting a little prepared psychologically and also from an approach perspective. So here's what the S&P 500 looks like. The question is it getting long in the tooth from a cyclical bull market perspective? I would argue, yes, it is. This is the S&P 500. You can see we had a long secular bear market from the 2000 top all the way into 2013. And of course, then we started breaking into the new secular bull market, all of which sort of, came out of the ashes of the financial crisis in 2008, 2009. At the same time, from a simple momentum perspective, if you look at something like the MACD, which is also known as the moving averages, convergence, divergence oscillators, you can see we're basically at pretty much all-time highs right now. So again, that's not a catalyst in and of itself to start dumping all your stocks, but it is something worth keeping in mind. So both from a time perspective, from a momentum perspective, from a volatility perspective, i.e. complacency, we're probably getting pretty close to some sort of volatility spike. That doesn't have to be the top of the market just yet, but an increase in volatility, and I think that's going to catch a lot of people flat-footed. Here's what I call the hungry alligator chart, the hungry alligator. And basically what I did here is I just took the S&P 500 chart, that's the sort of the candlestick chart, that colorful one, and I juxtaposed it or overlaid it to the VIX, the S&P 500 or the CBOE volatility index, so the implied volatility of the S&P 500 options. And you can see that this sort of hungry alligator, which is this mouth that's opening here, and you can kind of envision the body here with the tail and, you know, that kind of thing, is essentially getting very, very wide. So what I'm doing here is I'm just taking the past two charts that I just showed you and putting it on, slapping them all in one chart, and you can see where the concerns kind of come, you know, start to arise. Now again, this in alone is not a reason to start dumping all these stocks, but it is something to keep in mind. I do think it's most likely going to cause a shift in market environment over the next, you know, maybe as soon as the next couple of months. Maybe you have to wait another couple of quarters, but I do think we're much nearer than we were certainly at any point over the past 8 years, to be very simple about it. One more thing quickly before we get into the meat of the presentation. Passive management or indexing has outperformed in recent years, and you hear a lot of guys, they go on TV, or a lot of people talking about, you know, that active management is dead. In other words, an active investing or an active trading approach is no longer working. A lot of people are declaring that dead, and usually when you hear that kind of language, at least throughout my 20-year career, that's been usually when we got pretty close to a market top, when all of a sudden the active management came roaring back. So as volatility begins to rise, we're going to see a massive improvement in returns, and literally usually we see dramatic outperformance in active investing management as opposed to the passive management. So that's just a little bit of context for you. And so let's talk about well, actually, let's talk about one more thing here, and this is really one of the things that a lot of people don't talk about. Many in Wall Street right now that are working on Wall Street have never seen a bear market in stocks. Now, let me explain. During the financial crisis, and I worked there too during the financial crisis, a lot of senior staff got laid off. Over time, they were replaced by juniors or just much younger people that cost a lot less money. So the majority of these trading desks right now are staffed with people that have literally never seen a bear market in stocks. To me, that is one of the most dangerous things you can see, because once we start an uptick in volatility, that's not going to be good. So this buy the dip mentality, in other words, has become an epidemic. A lot of these people out there, they're pounding their chest by having, you know, been long the stock market if they've never learned anything else. And so, you know, they buy every single dip. The S&P drops a couple percent. They blindly buy it because, well, that's worked forever. And again, they shouldn't be fighting that until it stops working, but at some point it will stop working, and they will not be in a position where they will be able to react to that because they don't know anything else, right? So if you've been in the market for less than 8 years, okay, you probably won't be ready either, and that's not to call you out, it's just probably quite simple a fact. If you've done this for more than 8 years, you know, you may have seen a spike in volatility, but you're probably not yet at a point where you would be able to react to it as quick enough, because we've all become complacent, myself including. So I'm trying to get myself in a position where that sort of gets kicked to the curb. So once this buy the dip mentality, once the buy the dip stops working, then a lot of people a lot of traders are going to freeze like deer in headlights, certainly on the Wall Street side, and of course also on the retail side. So market volatility spikes are going to cause a lot of interesting situations. So what I'm going to talk about today, you guys, is candlesticks, and literally we're talking about the one pattern that'll change your game, and we're going to very specifically focus on an indicator and a scanner tool that I use that I think is going to be absolutely crucial once the market environment starts changing. I do think it's already slowly underneath the surface starting to happen. That's me. Just quickly recap. I've been very fortunate throughout my career to have worked both on the buy side and on the sell side. I just talked about it a little before. And so through these trading desks I've worked at, and of course now on my own managing money for the past now 7 years, I think it's been, almost 8 years, I've seen a lot of different markets. I've worked with some of the best traders in the world, and I'm very fortunate now to be able to pass this knowledge, not just to my direct clients, but certainly also to my subscribers and my students that are following me. So that's good stuff. Now, in terms of trading in general, I'll quickly just go through a couple of key points here before we dig into the meat of it all. A lot of people make things much too complicated. There's no doubt about that, in my opinion. They look at way too many conflicting data points, and particularly when the market starts to turn and when we do start to see a shift in the market environment, which, again, I'm not here to start saying dump all your stocks. It's not my thing to say. I'm not here to give you investment advice, so to speak. But from an education perspective, what I do know is that the more complicated your process is, the more difficult it's going to be for you to be able to detect once that market actually starts changing. So we want to keep it simple. We want to be able to eliminate that noise, and the more straightforward your process, the easier it's going to be for you to be able to stick with it. So the very best professional traders, have a very simple but repeatable process. In fact, the two best traders that I know, they literally have I think one of them has two specific patterns, or sort of, I'm going to call it, for lack of better term, systems of looking at the market. So if the very best traders only have a couple of sort of patterns to look for, then is the average retail trader trying to become a jack of all trades? It's kind of something a little bit to think about there as well. So like I said before, institutional traders, guys at hedge funds that I talk to on a daily basis, they, for the most part, have a very simple but repeatable process. So what I'm going to show you guys today is a very effective, repeatable three-pronged trading process that, particularly combined with the tool and scanner I'm about to show you guys, is, I think, going to be absolutely imperative from here on in for the next couple of years, certainly as the cyclical bull market is very long in the tooth, and even the secular bull market, your sort of 15-year rotation is certainly getting into the latter stages of it as well, and that's going to make it for a much different environment than the first part of this bull market in equities, in U.S. equities to be specific. So I think what you're going to learn here over the next, we have another 40 minutes left max. I know everyone can do this, and I'm going to make a very big claim here, but I think literally by the time we're through this, it's going to change the way that you look at financial markets. So let's look at this a little bit more closely. So what we're going to look at here first is looking at the market and learning it by sort of understanding an investor mood. We'll look at it in different time frames, and then we'll reveal and unveil the beater indicator and the scanner and how that works, particularly well when the market starts getting a little bit more volatile, although it's been working unbelievably well already. And I'm going to give you guys real-time examples so you can see that I'm not just making up stories here. Okay, so quick note about candlesticks, right? Candlesticks to me are an essential tool when it comes to trading. Just about any hedge fund and an institutional investor that I speak to use them from an execution perspective. They do give us a lot of information. And there's this thing out there where people read these books on candlesticks, 200-page books, and they read all these funny pattern names. And I'll tell you, to be honest with you, I think most of them are just kind of useless to learn. I mean, the reality is that only a few candlestick patterns and chart patterns actually repeat often enough for you to be able to sort of, so that it would make sense for you to actually learn them. So I just like to focus on the ones that work, shocking as that might sound. So when we look at a candlestick here, very simply, you can essentially have a down day, which is this black candle here, or an up day. I'll start with the down day first. You have an open here, a lower close, and then an intraday range that extends above and below this range. Then on the opposite hand, we could have an open here, a close higher on that day, or an intraday range that extends above and below the close. Well, what this creates is this sort of 4-point relationship between a daily high, low, open, and close. And so to me, the close, or the daily close particularly, or the close of any candle within its given time frame is very, very important. And you guys will see how important that is when it comes to the pattern and the tool that I'm going to show you guys in just a minute. Now, one more thing real quickly, I think this is important to understand. Candlesticks can be used in any time frame. So whether you are an active investor, which is more like what I am, multi-day, multi-week, multi-month kind of time frame, or you're a day trader, or you're looking at stocks or commodities or currencies, really candlesticks work with anything. It's just a matter of making sure that you use them in the time frame on which you are focused on. So one more thing that I think is very important as well for context, it's important to understand that most people are very visual learners. So we did statistics, we ran statistics on this. The official statistics by sort of more the academic research is that about 60% of us have an easier time learning stuff by looking at it through a series of pictures. I will tell you that our own studies have revealed that it's more like 80% of people that have an easier time learning stuff by looking at pictures, and I'm sure plenty of you can relate. And why is this important to trading? Well, quite frankly, candlesticks and charts and that stuff in general is something that lends to helps us be able to depict what the market may be doing going forward. So candlesticks in particular give us a lot of information. So let's talk about that. Well, the benefits of the candle are, multiple things. I mean, for one, obviously they're much more visual than your typical bar or line chart. And by the way, who in here is using candlesticks? I don't know if you guys want to quickly type in a yes if you're using it, or a hell no, I'm not using it, into the chat box. But essentially, they give us a much clearer representation of the chart, and I think that's incredibly important. So, most important though, what they actually do is they display price action through the lens of investor sentiment and footprints. So not only do we get price action, which obviously is what it is, but what the price action is telling us is what investor psychology and investor sentiment is at any given point. And if you can constantly focus on that, you have a much higher probability of making money in the markets. And certainly once volatility starts to increase, okay, you are going to have a huge advantage over the rest of the players who most likely are not doing that. All right. So a little bit more on candlesticks besides the fact that they just work. The formations are very easy to spot once you've trained your eyes. It's all about decision making without emotions. And I chose this picture of this person on the cliff here because this person has a very defined risk and a very clear stop loss. So if he or she goes beyond this point of no return, it's pretty much game over for her. So it's the same thing with using candlesticks, and I think it's one of the greatest aspects of candlesticks. We know exactly where to get in, and also a lot of time where to get out, and so that's going to be even more important once volatility starts to increase in the market, which I do think we're much closer to that at any point over the past 8 years, obviously, right? Because we haven't seen a real volatility spike that lasted for more than a couple days or a couple of weeks. So let's look at a couple types of candlesticks. Like I said before, I think a lot of people, and maybe some of you have already read some of these books. Again, these are some funny 200-page books on candlesticks, and they talk about a lot of stuff, and it's not uninformative. It's just that it's making it much too complicated. Because if you look at it through the lens of investor psychology, you can really make things much simpler and much higher probability. So there's multiple types of these so-called hammer candles. I'm going to make it very simple for you guys. You know, my sort of small brain can only handle so much. And I think sort of the number one you want to focus on here is your regular old hammer, which is the one here depicted by number one. So let's assume we're looking at a stock here and looking at it through sort of a multi-day, multi-week lens. Let's assume this was a stock where the trend had been lower for the past few weeks. Well, ultimately, the stock came into this day, and you can see it opened here, and then it quickly reversed lower, and at some point within that day, it started reversing higher. So there's two ways of looking at it. Well, number one would be sort of your typical financial television way, which is like sort of, we're off the lows, Joe, back to you. Again, nothing really wrong with that statement, except that it's completely understating what actually happened, because what truly happened is that the sellers, or the bears, who've been in charge of this market for, let's say, the past few weeks, they tried their very best to push that market lower one more time. But they failed to do so, and the market quickly roared back, so much so that it actually closed a little bit higher on the day. So what really happened is that maximum bearishness occurred here. So the bears could no longer keep the market down there, right? Very, very simply and straightforward. So if you can depict these maximum points of bearishness, you have a huge advantage over the rest of the market. Now, what happens when the sellers run out of steam? When there's literally no more sellers left with any given time frame, what's the only thing that can happen? Well, really, the only thing that can happen is that the stock starts to bounce, or at the very least, it'll go sideways. It will stop going lower. So again, we're looking at candlesticks in a much more straightforward way, and again, this is going to become even more important once volatility increases, because once volatility increases, the emotions are going to spike, and if you don't have something to hold on to then, it's going to be very difficult for you to make money, and most likely, because most people are going to give back a lot of gains once the market starts to get more volatile, because their emotions start to basically run rampant. Let's have another look at another example here. We'll look at the engulfing candle. This is what we call an engulfing candle for a reason. Again, I'm not too big on the names, but in this case, you can see we're actually talking about an engulfing. This candle is engulfing the previous day. Anyway, let's look at this example here. We have an uptrend. Okay, let's give you a bearish example in this case, just to kind of mix it up. And you can see that this uptrend, the bulls were in charge clearly. And on this given day, they just kind of, rallied the market higher one more time. So something, however, happened then is the sellers basically took over the market. The bulls completely ran out of steam. The market gave back a lot of its gain, in fact, all of its gains for the day, and then some. Again, we could look at this through the lens of financial television, which would be to say something like, we're off the off the highs, Joe. Back to you. And again, it's not a wrong statement, but it does dramatically understate what actually took place. Because what really took place is that the bulls who'd been in charge here for the past few weeks, they tried it one more time to rally the market, completely failed, ran out of steam, and the market dropped. So again, what we're getting here is a very visually obvious point in time where the bulls ran out of steam. When that happens, what's the natural, logically next thing that can happen? Well, in most cases, this depicts a very, very clear exhaustion of the buyers, of the bulls. And when maximum bullishness is reached, the only thing that's going to happen for the most part is the market's going to go lower, maybe it'll go sideways. All right, so these are some basic concepts. Let's have a look at a couple of charts. What we're going to look at here first is the S&P 500. So let's just kind of go through it and look at the chart itself. This is the S&P 500. This was at some point in 2014. There's plenty of examples I can give you that are much more recent. This is just a very visual one to make a simple first example for you before we go into more current ones. But you can see we had quite a sharp sell-off in the S&P 500 here at some point at this point, and it was sort of a multi-week sell-off that increasingly got more vicious. And at some point, the sellers just got very, very exhausted. You can see that visibly, these long tails. Well, this happened for 2 days in a row, and ultimately on the third day we had what's called follow-through buying. So I'm sure on financial television, these guys were all about saying we're off the lows, but if you really think about it, certainly once you have what's called follow-through buying, it becomes very clear that the bears got very, very exhausted down there. There was literally no more sellers left within that time frame. And if you can visibly detect this kind of stuff, particularly when the market starts to get more volatile, it's going to be much easier for you to make money in the market and certainly to keep your money than if you don't have this look at investor psychology through the lens of price action, which I think is a vastly superior way of looking at the market than just through the lens of price action in and of itself, or just ignoring the psychological aspect behind it. All right, let's have another example. This is the BKX, or the KBW Bank Index, which, by the way, as a quick sort of bonus tip, banking stocks are unbelievably important to watch at any given point. And what you can see here is that the banking index, the BKX, had quite a sharp sell-off at this point. This was in August of 2015. Then kind of bounced sideways, and at some point we saw the sellers come in once again, and they try to push the market lower below those August lows, where you can see that was basically, I don't know, a part of a day phenomena. Literally didn't even last a whole day. The bears completely rejected that low. They ran out of steam. They couldn't hold that market down. Sure enough, the next day we had a confirmation follow-through buying day, and really was off to the races there. So you can see that through the lens of investor psychology, when we look at price action through the lens of investor psychology, we can tell a lot. And that's really the key here when it comes to candlesticks, and that's why I think this is unbelievably important to use when volatility starts to increase. And again, underneath the surface, it's already kind of starting to happen. If you look at some of the things that have taken place over the past few weeks, and this is really, to me, a hugely important part of analysis once the major market turns. S&P 500, or excuse me, the SPDR, the Spider Gold Trust, the GLD. Here's a bearish example in the gold ETF. I'm sure plenty of you have traded or at least are aware of the gold ETF. You can see we had a sort of a multi-week, multi-month rally here in gold, and ultimately we kind of topped out, and then the bulls tried their very best to push this market higher one more time. You can see they probably tried to get that gold price back up here to these previous highs, but they completely miserably failed. And again, through the lens of financial TV, on that day, I bet you would have heard things like, oh, we reversed all the day's gains, we're off the highs, that kind of stuff. Again, that's not to say that's incorrect, but it's totally understating what's taking place, because what happened here is that the bulls ran out of steam. They could no longer keep that market higher, completely reversed, and when that happens with follow-through buying the next day, there's really only one thing that can happen for the most part, and that's the market goes lower. Again, at the most, at the best, in best case, it'll kind of start to trot sideways. But for the most part, that's a meaningful part of the market that you want to focus on. I'm going to skip this Hewlett-Packard example in the interest of time because I want to give you guys a lot of more real-time examples. But I want you guys to write down these 3 steps to the trade, and this is going to make this is even more important again as we start to see the market shift or get more mood swings, I should say, is probably the best way of putting it. You may want to write this down, maybe take a picture with your phone, whatever you got. Step number 1, you got to have an idea of the broad market structure at any given point. I know a lot of people talk about just using an indicator and this and that, but I strongly believe that over time, you have to have an idea of sort of a big picture market environment. If you just look at an indicator, it's going to be too confusing still. Even though you have something to hang on to, you have to have some grip on what's going on basically in the broad market. And for the most part, that means what's going on in terms of monetary policy, maybe the political environment, that kind of stuff. You know, where are we in the bull market? Are we late? Are we early? Are we mid-cycle? You know, you don't have to become a political or an economic analyst, but I do think this is important to understand. So once you understand kind of where we are, you then need to narrow that down to a set of stocks that are looking, you know, more interesting. So like right now, for example, to me, we're narrowing things down into sort of late stage, you know, cyclical bull market stuff. Tech remains a name, you know, higher beta things like last week, of course, the story has been biotech are still rotating, but we're trying to stay away for the most part from banking stocks right now and things of that nature that are just not yet ready to go in this environment. And then step number 3, once you start to, you know, see bullish and bearish reversals very clearly in this set of stocks, you then can actually go in and start acting upon those. Now, there's actually a shortcut to all of this if you want to, because you can actually reverse engineer this process. So if you were to start, and let's say you came across a very strong bullish or bearish reversal, you could actually then reverse engineer this and see if that bullish or bearish reversal is in line with the set of stocks you identified that should do well or not do well in that environment, and then of course still make sure that step 1 is in place. By the way, someone has a hot mic. I don't know, moderator or someone else has got a hot mic. Just FYI, so that we don't have any accidents here. Let's have a look at step number 1. Let's kind of walk through this real quick, and then I'm going to show you guys what I really think is key here in terms of execution and how we're going to use the tool and the indicator. So the S&P 500, we talked about it before. The example we looked at before was right around here. So this was October 2014, and I remember getting a lot of phone calls and emails and texts and whatever else. My phone was lighting up from a lot of my clients around the world, and they were asking me if it's time to sell. Well, I said, listen, let's have a look at the step 1 through 3 process. Well, step number 1 at the time, broadly speaking, the Fed was still being very accommodative for a U.S. economy. Number 2, the economy was still growing. And number 3, you know, just purely from a technical perspective, we were just basically getting back to trend, back to the 2011 support line. So I said, listen, let's hold off. Let's wait on a weekly close. Sure enough, we had a very strong bullish reversal. We waited for a follow-through buying week. And after that, it was basically off to the races to the upside. And that's, you know, we gave the green light for everyone to go ahead and buy, and that's not to sort of pat myself on the back. It's just I'm trying to show you that if you have a process in place that's repeatable and straightforward, you can very easily make money in the market, but you got to have a process. Most people do not have a process when it comes to the market. So let's see. The other example here would be in the KBW Bank Index. This is the BKX we looked at before we looked at this point in time right here. So step number 1 is the broad market structure. This was like autumn or the fall of 2014, I believe, or 15, I think. And this was the point in time where the Fed started to talk about an initial rate hike, excuse me. And of course, we know that later on that year they did hike rates. So from step number 1 perspective, once we saw that rhetoric, it became very clear that we need to start being a little bit more bullish, or at least cautiously optimistic about financial stocks. And so once we started seeing that bullish reversal both on a daily chart that I showed you before and on the multi-year weekly chart here, that strong bullish reversal, it became very clear that it was an opportunity to buy to buy that index or that stock, banking stock specifically. So here's a couple things we need to now talk about. If there's one thing you take away from this presentation, and this took me literally 11 years to learn. I'm now 20 years into my trading career, but took me 11 years to really sort of respect it. Okay, and that's the following. I don't want you to do this. I do not want you to focus on just 3 or 4 stocks or one index or 2 currency pairs or 1 or 2 commodities and then take every single signal that you get from that. I think that's a really bad strategy. Here's why. The real high probability signals, and I mean like truly high probability, are only going to show up every so often in any given stock, index, currency, or commodity. That's just a fact. So by only narrowing your universe on a couple stocks or just a couple assets, if you will, you are executing a low probability strategy. So what I do need you to do though is basically the opposite. The world is your oyster. Okay, you need to find a high probability strategy or signal, and I'm going to show you guys my B2 indicator in just a minute. And then you look for that signal across the universe of stocks and or commodities and currencies. So think about it. Why do you think hedge funds are structured the way they are in the sense that they can take advantage of any opportunity out there? It's because they know that true high probability strategies, and I mean like true, I don't mean like some 50-50, gambling kind of probability or a 60%. I'm talking about, 75, 85% at least that you actually can have a profitable trade. Opportunities of that nature set up every single day, every single week of the year, but they don't happen in the same asset. So if you look at the shares of Apple, for example, Apple gives you maybe, and I mean from a daily perspective, like, from a daily chart perspective, like one day at a time, gives you maybe a couple good opportunities a quarter, maybe a couple opportunities a month if you're really lucky. It's just a fact. So that's really, really important to me that you understand this. Okay? So let's talk about strong bullish and bearish reversals in summary real quick before we start unveiling the curtain here. So a strong bullish reversal is where sellers get exhausted, and a strong bearish reversal is where buyers get exhausted. In other words, where the last of the buyers buy or the last of the sellers sell. So what's key though, and that's what most people don't do, professionals and certainly not amateurs, is they don't wait for price confirmation because most people are very impatient, and that's just human nature, right? That's not necessarily your fault. That's just because we as humans are impatient. So but once you've got that price confirmation, you get the very highest probability spot to buy or sell any given stock. So let's take a little bit deeper. So what I want to show you guys here today as my tool, everyone's showing a tool here, but my tool that not only is working amazingly well in this market environment and has been along the entire market higher the past 8 years, but also I think is imperative for when the market starts to shift, and again I think it is starting to shift. It's what I call the B2 reversal indicator. This was a multi-year project, and I'll tell you, I've never been a big fan of indicators. When I used to work on the institutional trading desks at JP Morgan and things like that, we had a lot of people always come by showing off their software and things like that, and I never really found anything that worked because most things were way too complicated, and most people only worked like a few, in certain market environments. But about 5 years ago, I said, you know what, I've not done this for 15 years, I've got this approach and it is working, so I wonder if we can, program part of this. So I went to my friend, and it was kind of just like one of those Thursday night tequila cheers things, and I wasn't even that serious about it, but I said, hey, you know what, I've got this thing, can you program this? And he came back a couple of weeks later with the initial scan, the initial version of it, and it was absolutely amazing. It had literally changed the way I started trading. So he came back, and what we now have is this B2 reversal indicator that gives us these high probability, straightforward buy and sell signals on the charts based on multiple parameters. Okay, this is not a single factor model. Single factor models don't work. You got to have a fairly holistic approach behind something like this. But it's absolutely beautiful. So let's have a look at what this actually looks like. So for example, here we have shares of Tesla, and you can see this was just last year. You can see we had these beautiful red arrows show up here, and follow through selling in the market proceeded to drop about 18-19% very quickly. So that was our literally just the arrows appear in the chart, and you watch it, see a signal, and you act upon it. WHR, sell signal here, the stock dropped 13%. Then we get a buy signal here, and the stock rallied about 15%. And then we get another sell signal, and the market dropped about 50%. So you can see that there's a sequence here that this can also come back to back if the market warrants it. Starbucks, for example, we had a sell signal here just last August. The stock proceeded to drop about 7% over the course of the next couple of weeks or so. IMAX, we had a beautiful, beautiful bullish reversal here, and the market rallied very quickly over the next few days, rallied about 10, 12% or something like that. So very, very juicy trades that we get with this kind of a setup. And again, this has been working very well in the current market, but I do think this is going to be absolutely imperative to use, especially once the market volatility starts to increase. Apple, I'm sure plenty of you have owned or do trade Apple, or you can see here we had a buy signal take place. Actually, just last September, market rallied about 8% very quickly after that, and of course it remains in a broader uptrend. So again, green arrow, buy signal, and off to the races we went. Now, after a while, I said to myself, I'm not necessarily considering myself to be lazy, but I know we all try to make ourselves, make things easy for ourselves if we can. And so I told my buddy, hey, listen, is there any way we can develop some sort of a scanner that just kind of gives us these signals without having to, spend 2 hours a day clicking around the market for opportunities? Because up until that point, I seriously was looking at the market for like 2 hours every day, or an hour in the morning, maybe an hour in the evening, just to look for signals. Forget doing research, just looking for valid buy or sell signals. So he came back, and it just really blew my mind, and it literally changed the way that I structured my day. And that's after, at that point in time, I was already a trader for 15 years. So it dramatically reduced my trade idea generation time. I used to spend, like I said, 2 hours a day searching for something. Now it's like less than 20 minutes. I wrote 20 minutes. Honestly, it's probably less than 15 minutes. It's really a short period of time to look for stuff. So here's what it looks like. So I've got the stock scanner here, and what I do is I've actually got them programmed into watch lists. And so I just open up my platform in the morning, and I get the signals here, and I click on them, and I put a chart over here on the right-hand side, and then we look for the signals, right? So let me quickly show you guys this in real time. Okay, let me just quickly bring up one of these. So like one of them that just came up on Friday, just so you know, it's an FYI. It was this one here. All right, this is a real-time one, real-time watch list. So I clicked on NVR, just the top one that came up, and you see we had a sell signal here. Look at the buy signals we had here. Buy signal, and off to the races, right? So that's literally all we do. We look for this stuff. There's 2 bearish scanners, 2 bullish scanners, and yeah, there's a lot of questions here, guys, and I'll get you guys to your questions in just a minute, but the short answer is that yes, you can work it in all time frames. Let me show you guys just a couple more examples here before we go a little bit further here. But essentially, it works in all time frames, and it doesn't matter whether you're trading currencies or stocks or commodities, or you're a day trader or a multi-time frame. It doesn't really matter. Like, for example, look at some of these examples we got as of late. Like, here's just one that just comes to mind that we did also for live in the clubhouse with my students and members. We got a buy signal in Triple D here on the 5th of May. Another one the next day, even, and boom, off to the races. Stock rally exploded like 35%. Got another one just a few days ago. Buy signal here. The stock so far is up about 8-ish% since then. Again, I'm not making this up. This is the signals are just there. So it is what it is. From an intraday perspective, I'll show you guys this real quick. Let's see. This is the intraday chart. Let me show you guys this just so you can see it. Yeah, I'll show you guys all the stuff in the indicator for where it works and all that stuff in just a second. So here, for example, this is literally just again, just so you see, I'm not cherry picking. Like, this is literally just on Friday, like yesterday. Okay, this is the IWM Russell 2000, and I'm just picking something randomly. You see the buy signal here? There was a sell signal here, which you wouldn't have taken because there was no follow through selling. I'll show you guys that in just a minute. But here's a buy signal with follow through buying. And the S&P or the Russell 2000 rallied 40 basis points right after that. So you can use it for day trading. You can use it for multi-day, multi-week, multi-month, multi-year. We use it in all time frames as a real basis. So in summary, real quick, and I'm going to show you guys a ton more examples here in just a second. A candle shows the footprints of and emotions of traders and investors. So what you want to have is a straightforward and repeatable process, because that's really going to be the key to consistent profits in the market. But at the same time, we do really need a tool and a process to keep us in check once the market starts to turn. And this not just when the market starts to turn, but absolutely then it's really important, because a lot of people, and I promise you, once this market starts to get more volatile, and again, I'm not here to call doom and gloom. That's not my thing. I've done this for 20 years. You got to respect both sides of the market. You cannot be a successful trader or money manager, in my case, unless you respect both sides, respect all possible outcomes. You cannot fight. If you start fighting the market, all bets are off. And that's why this tool is so critical for me as a core to my money management advisory business, and certainly also for the clubhouse and everything else that we do. So what I'm going to offer to you guys today is my Ultimate Candlestick Bootcamp, which includes this indicator and scanner, and I'll show you guys this for much more in just a second. So first of all, what this is an 11-part recorded video series with all the instructions on how the process works. And in that, you're going to learn the low-stress, high-probability swing trading method that I preach, the way I manage money, the way I do advisory, all the stuff that we do. And you're going to learn how to nail reversals by correctly reading investor sentiment and emotions using candlesticks, and much, much more. Usually this goes for $500. We're going to give it to you guys just for $197. You can go to thesteadytrader.com/green. And again, this includes the indicator and scanner, so let me just get to that point. Here it is. We also, by the way, have, for anyone that owns this, we do recurring webinars, bonus webinars. So we do them about once a month for the next few months or so. You're going to get to learn even bonus tips and tricks for this as well. So it's not just a one and done thing. I don't believe in just selling you one thing and that's it. I believe in educating you as the market continues to change and as we add stuff to this as well. And all updates, by the way, are included as well. And everything is recorded. So any updates further on this indicator and scanner will definitely be included. I would say this quickly though on the course, I don't believe this is something that is for people who can't be patient. I think you have to be someone who actually is serious about trading. So if you're not serious about trading and you're impatient and you're just kind of in it for fun, I don't think this course nor the indicator is for you. This is really meant to be for people who are serious about it, who actually do want to make money in the market, and not just treat it as some sort of a side hobby that they're not really really serious about. So let's talk about this a little bit more in detail. This works with anything. This works with stocks. This works with indices. This works with ETFs. This works with currencies. It works with commodities. And I'll show you guys examples in just a second. But basically, what you're going to learn in the course itself, just so you know, there's an 11-part video series that comes with it and an ebook. You're going to learn all the different variations of bullish and bearish reversals using candlesticks. You're going to learn all the stuff that matters, okay, and none of the stuff that doesn't matter. You're going to learn my rocket launch and gravity pull setups. You're going to learn how to do proper multi-time frame analysis, which, as a money manager, I can tell you is imperative to making money over time in the market, certainly when markets start to turn. You'll learn about confluence zones, what that is, what it means. You will learn about sideways channel breakouts, how to correctly do all that stuff with candlesticks, resistance and support lines, all those kind of things, correctly using moving averages and oscillators, and even Fibonacci retracements, and much, much more, all within a reasonable, realistic trading approach and investing approach that actually works. You learn where to set your stops, a little bit about risk management, and of course a little bit about the mental aspect of trading as well. Yes, I'm going to give you guys a lot of examples. I see there's a lot of good questions coming in. So let's talk about the indicator real quick for a little bit more before I show you guys a lot more examples. Number one, these signals literally just flash in your charts, and I'm going to show you guys more in just a second. It works in all asset classes, and it includes the scanner. Okay, so the scanner, literally, you install it, you run it in the morning, you look for opportunities, and that's the process. I'm going to show you guys in just a second. So what's it available for? So a lot of guys are asking, like guys and gals, of course. So number one, it works with Thinkorswim, which is the platform that I'm showing you here, because that's part of part of the tools that we use. It works in eSignal, it works in TradeStation and NinjaTrader, and also it's working on TradingView.com. All right, so that's where it's working right now. Let's see. So let's go through more examples, guys. Let me show you guys more examples. Let's go through this stuff here. I'm going to leave this up here, and let's see. All right. So let me just show you guys a few examples of late. So Anthony, you saw it doesn't just work on stocks; it works on other stuff. And you have, Rebecca was asking about the confirmation. Yes, you have to wait for confirmation. Let me show you guys how this works. So for example, let's have a look at the Russell 2000. Again, we're just looking at this is the IWM ETF. Okay, you have to wait for confirmation. That's the most important thing. So let's look at, for example, this here. So you had a buy signal here, but you need a real confirmation. Like this has to be a strong follow through buying day, and that didn't happen until here. So you wouldn't have gotten the buy signal until here. So let me show you, I guess, for example, in triple D, the example we saw before. Okay, so here's triple D. Okay, you can see we had seller exhaustion take place, and then we had a buy signal, and this was a meaningful, powerful follow-through buying candle, right? This has to be a significant buying day, and then you can buy it. And again, it works in any time frame. So if we go back to the intraday chart of the Russell 2000 before, let me show you guys real quick. Intraday here. So this was, again, this is literally just on Friday. See, the reason why, so this one actually technically would have been a sell signal, but it really wasn't, because you don't want to take it on the intraday in the first like 5 minutes. It's just not something you want to do. But for this specific signal, but here you can see we had a buy signal with serious follow through buying, and then if that's the setup, I know someone was asking before, what's the percentage? If it's a qualified setup, Greg, it's going to work like 90% of the time. That's roughly where I think the stats are. Well, I know where the stats are. If you get a true qualified setup in any time frame, it does work 90% of the time if you contextualize it within reason. Okay, so that's what we're looking at. Let me show you guys a few more examples here. Like for example, I got very bullish on biotech stocks just on June 1st, and that's because of this. You guys see that? There's a buy signal that came on June 1st, which was already a confirmed buy signal. It was a meaningful update on the day of the up arrow, right? And then so I started buying some there. I can show you guys if you guys want to see. I'm sure I can show you guys the real-time text alert that I sent to Clubhouse members as well. But then we tried it sideways, and then we actually had another one that it didn't print on this, but we had another one take place here, and we started ramping to the upside, another beta reversal. And the beta reversal, to show you guys know, it's basically based on an amalgamation of things like candlesticks, also in terms of slope and momentum. So it's not just candlesticks, because that alone doesn't really give you a valid enough signal. It's a couple things together, and then you contextualize that, and that's why the course is for as well. Okay. Also, for example, we just had a beautiful buy signal take place in Amgen. This is a biotech stock here. You can see we had a buy signal here, but it wasn't really powerful enough. You needed a follow through buying day, and ever since then, Amgen is up 8.5%. You guys see that? Okay, where do you set the stop? Okay, good question from Z. Where do you set the stop? So once you get the signal, your absolute worst, let's go back to DDD just because it's visually the easiest one to show you. So let's look at here. So you can see we had a buy signal here, right? So your absolute worst case stop, yes, I can make it larger. Sure. No worries. There you go. All right. So see here. So this is your buy signal. So your absolute worst case stop is right down here, right? That's your worst case stop. Who was asking that? John, I'm not mistaken on 90%. I'm talking about qualified signals, not just a random signal with this. It's a qualified signal, okay? And what you're going to learn what a qualified signal is, John, in the course, and certainly when we have the bonus webinars. And by the way, guys, if you have questions, I'm actually personally available. Like, you can call me. I will talk to you on the phone as well. So it's not just, even though we have thousands of clients, I actually believe in the personal touch. Unlike a lot of people out there, I think that's actually really important to also build that relationship so you can trust me. It's all about building trust ultimately. And the same thing here with Triple D, right? So we had a follow-through buying. I actually waited in Triple D for the latest signal for another follow-through buying day. So far, I don't know, what are we up? I think we're up a couple percent, 4 or so percent in Triple D since. So that's just a couple of these examples. Yeah. So actually, the signal comes at the beginning of the day or the beginning of the candle. Okay, but I like to wait for the candle to mature a little bit. Until if you're using it on a daily basis, I use it. It's going to it's going to have to mature a little bit, like until, let's say, the late morning session into New York time. Okay. All right. Z, you can just you guys can send us an email. It's support@thestudytrader.com. If you have questions, then we can set up phone calls from there. Yeah. If you guys want to get more, yeah. And so like I do this with options a lot. So I will, for example, in Palo Alto Networks, which is a great example here. We actually got a sell signal. Let me just show you this real quick. All right. Yeah, support@thestudytrader.com. Just like you can see that here, it's thestudytrader.com. So we actually got a sell signal in Palo Alto Networks a while ago. I didn't take this because I remain bullish in the stock. And when I just got long on Friday again, but the key is to wait for follow-through buying. Yeah, it's going to work in any time frame, Anthony. I mean, I don't like to use it on shorter than like 1 minute time frames, you know. But like I showed you before, I mean, it's going to work on any time frame, really. I mean, let's just go back to that IWM example from before. Let me just quickly go back to that so you guys can see again. It's something that works in any time frame because it's based on price action, right? So here's, for example, a couple days ago, right? So let me show you this. This I think was Wednesday. Okay, we had a buy signal here, which was a confirmed follow-through buying. We had another bar higher than the next 5-minute bar, so that was good enough. And then we were off to the races. All right, then we had a sell signal. This was confirmed follow-through selling, but usually, from a day trading perspective, that's something you have to kind of figure out on your own. Yes, the alert service comes with entry, target, and stops. That's the Clubhouse membership. For those of you guys that are interested, you can pick that up. I think once you purchase this, there should be an offer for that pops up on your screen. So that's that. Let's see. All right, let's see. Someone wants to know about what was the stock? Someone wanted to know about Starbucks. Sure, we can look at Starbucks. Yeah, you guys give me some tickers you want to look at, by the way, just so you guys can see I'm not making it up. Let's see here. Let me just quickly bring up that chart. Sorry, I had to get back to it. All right, so Starbucks, sure, let's have a look at it. Here. So here's Starbucks just the last while. So again, you guys can see how it works. We had a sell signal here. This was on the 17th of May with no follow-through selling, so you would have not taken that signal. But then we had a buy signal, okay? And that buy signal was very, very strong because it came on the back of this exhaustion selling candle. And so that was already a buy signal. We went long. I bought the stock. We had I believe a 63 or something initial price, or 63.50 I think it was the initial price target, and we're off to the races. So again, it's about waiting for confirmation. To me, that's incredibly important. Yeah. Sure. Yeah. I mean, let's look at Home Depot, for example, right? So look at Home Depot. Okay. And again, you guys will learn much more about this in the course. But you can see, for example, here we had a buy signal, and you need to wait for serious follow-through buying, which took place either here or here, right? And then you could have gotten long, and then we had sell signals, but no follow-through selling, so you don't go short, okay? And here we had a buy signal. This was not really any follow-through buying, and it remained stuck in a range. You need a serious follow-through buying, right? This too, no real follow-through selling. And now we have to wait. We might get a signal on this next week, certainly on the weekly chart. In fact, let's have a look at the weekly chart real quick. It may have already given us something on the weekly chart. Yes, it has given us a sell signal on the weekly chart. Here's Home Depot. You can see we had a sell signal here, and we finally had follow-through selling last week, this past week. Yeah? Yeah, listen, it's going to work in any time frame. What you're looking at here, you're looking at the price action in the underlying asset. Whether you then buy a weekly option or a monthly option or whatever you do, that doesn't really matter. The most important thing is that you use the analysis of the underlying asset. And I think that, to me, that's really the key with all of this stuff. So let's see. Let's go back to this chart here. All right. Someone wanted to look at NVIDIA. Yeah, sure. That's a big name. Okay. All right. NVIDIA. Let's look at a couple examples here. So let's see here. Let me just zoom in. All right. So for example, at the end of last year, we had an outside reversal bar and follow through selling on the last day of the year. And then the market didn't fall apart, but you can see it didn't really go anywhere for a while. And then we had a sell signal here, and the market proceeded to drop in September after confirmation selling. In February, it proceeded to drop, I think about, was it 20–30%? So you can see that definitely works there. All right. Let's see, what other things are you guys looking to do? Yeah, sure. Let's look at CL. All right, that's crude oil. Look at this. We had a buy signal here. Confirmation buying, and if you would have taken this, you could have easily made a few percent. All right. Again, we're not looking to bottom tick or top tick. We're looking to take the meat out of a trade. You know. Oh, sure. FFIV. That's a good one. Yeah. Someone wants to look at. That's Michelle wants to look at FFIV. Sure. No problem. FFIV. Outside day, outside bar. Nice follow through buying, and boom, off to the races. Then we had a sell signal, but it never really broke out of its range. So I would have, and I certainly didn't take the trade. But here you had a sell signal and follow through selling here, and then you could have taken that trade. So again, the key is to wait for the follow through buying or selling. Did that make sense, Michelle? Cool. Caterpillar, sure. Let's have a look at it. Just randomly picking a spot here. For example, you had a buy signal. Follow through buying, and sure, it didn't rally very long. We rallied to the upper end of the range, right? But then you get to the upper end of the range, and that's kind of where you have to make a decision again. But it worked, right? So you could have quickly made a couple percent. Yeah. Yeah, again, it's available for Thinkorswim, eSignal, TradeStation, NinjaTrader, and TradingView. Mm-hmm. Sure. Let's see, what else are you guys going to look at? First Solar. No problem. First Solar, let's have a look at this. So for example, in First Solar, all right, just take the recent one. So you can see here we had a buy signal with marginal follow through. Like we never broke out of the range, so you wouldn't have taken it. But here, sell signal, follow through selling, and the market dropped 15%. All right, see that? Who was asking about First Solar? Jim. Okay. Buy signal, follow through buying, and the market's still rallying. Okay, it's now up 40% since then. Sell signal with no follow through selling here, so you would have not taken it. Buy signal, which was already a confirmed buy signal with follow through buying, then quickly rallied 9%, and it's still you can still be long because the last resort stop loss is down here. Yeah. Cool. All right. Well, listen. I think I need to start shutting it down for me. But sure, let's take one last one here quickly. Bank of America. Bank of America's been largely range bound. There's been some trades to do, but you have to look for stuff that's actually moving. For example, here we had a sell signal with follow through selling, but this Bank of America is not really a trading stock right now. I think I would certainly steer clear of that. Yeah. Yeah, Palo Alto Networks, yeah, sure. So Palo Alto Networks, just so you guys know, for those of you guys who were asking me, we just got a buy signal in Palo Alto Networks, actually confirmed on Thursday upon these bullish TD2 signals and then follow through buying at the first meaningful follow through buying candle here. So yeah, go to the steadytrade.com/green. It's an 11-part recorded video series along with the indicator, the scanner, works with Thinkorswim, TradeStation, NinjaTrader, TradingView.com. And if you guys have any questions, let us know. We also do again the bonus webinars, and so it's all good fun.